All right, the closing bell just rang on Monday, January 12th. Let's get right to the scoreboard.
The final prints are in. S&P 500 finished up at just 0.12%.
Okay.
The Nasdaq slipped a tiny bit, down 0.08%, and the Dow was your relative outperformer, closing up 0.31%.
So on paper, an incredibly quiet, mixed session. But the institutional reports we're looking at are calling today a choppy mess.
Yeah, that's the perfect description, because if you just looked at the index price, you'd think nothing happened. But under the surface, it was a day of massive rotation and institutional de-risking.
And why the chop? What was the narrative driving this sort of wait-and-see behavior?
It's classic pre-event paralysis. You've got two huge events looming.
Right.
You have Wednesday's CPI print, which is, everything for the rates narrative right now, and then earnings season for Q4 kicks off. So institutional capital just hates that kind of uncertainty.
So the liquidity just dries up.
It thins out completely. Yeah. And when the market is thin, small trades can cause these outsized moves, but there's no commitment behind them. That's the chop.
And you could see that lack of commitment in the sector action. I mean, the divergence was pretty stark today.
It was severe. Energy was the clear leader, just surging 1.4%.
On those crude jitters again?
Exactly, the hard assets trade. But the counterpoint to that was the consumer. Consumer discretionary was the biggest laggard by far, down 0.9%.
And a nearly 1% drop in discretionary. That's not just noise. That's a direct reaction to cooling retail data, isn't it?
It absolutely is. It's a huge red flag. It shows money is actively leaking out of that soft landing consumer story and looking for a place to hide.
Which brings us to the internals. This is where you can really see how deceptive that flat SPX close actually was.
Yeah, let's look at the conviction check, because the volume and breadth tell the real story.
So first, the volume problem. I mean, just how low was the conviction on this move today?
It was extremely low. The aggregate exchange volume finished, get this, 9% below its 30-day rolling average.
9%. So the fuel tank was basically empty.
Completely empty. If an index tries to move on that little fuel, the move itself is just inherently fragile. It tells you the big committed players are on the sidelines.
So any breakout you saw intraday was basically just noise.
Just noise. You were trading against algorithms and short-term momentum chasers, not genuine institutional accumulation. That's why the signal is so low.
And that volume problem is just made worse by the breadth crisis. The reports are calling this the thin ice rally.
A perfect name for it, because while the S&P 500 was hovering flat, the internals were just deteriorating all day. The advanced decline ratio closed at a really weak 1 to 2.
So for every single stock that went up today, 2 went down.
Exactly. Think about that. Nearly 2/3 of the entire market was under pressure, but the index was held up.
Which is that classic generals versus the soldiers analogy.
It's the perfect analogy for today. The generals, your top 10 mega caps, they held the line. But the soldiers, all the mid caps, the small caps, the broad market, they were in full retreat.
So capital's just huddling for safety in those big liquid tech names.
Precisely. It's a flight to defensive liquidity, because they know they can get out of those names fast if the CPI number comes in hot. You just can't trust a market that's being held up by so few stocks.
And that leads to maybe the most concerning internal signal, the price-breadth divorce.
Yes. This is where it gets really interesting technically. The S&P 500 actually poked to a new tactical high during the day.
Right, fooling the breakout chasers.
Exactly. But at the same time, the new highs versus new lows index, which measures broad market participation, was trending lower. Price up, participation down.
And that's textbook late cycle behavior, isn't it? It suggests distribution.
It absolutely does. It means institutions are using the strength in the headline index to quietly sell their positions to retail traders who are buying the breakout. And history is very clear on this. Price always, eventually, follows breadth.
Meaning that breakout is much more likely to be a fake out.
The odds are very high, yes. The structure is just brittle. And we can actually see who is doing the selling if we look at the action to the close.
Okay, this is where you can see the institutional footprint. What did smart money do during that midday rally attempt?
They faded it. They used it as an exit door. And the proof is in the closing print. We saw a massive $1.4 billion market on close sell imbalance.
$1.4 billion sell imbalance. Wow. So break that down for us. Who was selling?
That was institutional money de-risking into strength. They were the sellers, using the day's high liquidity to lighten up their books before Wednesday.
The buyers were.
The buyers were the momentum crowd, and anyone mechanically forced to buy to rebalance. The buy the dip crowd got run over in the last 30 minutes of the day.
So that much selling pressure right on the bell gives us a pretty good hint for Tuesday's open.
It points very strongly to a soft open. It's rare to absorb that much supply at the close and then gap up the next day without some kind of major overnight catalyst.
And we saw this distribution playing out in real time in some of the market leaders. Let's start with NVDA.
Oh, NVDA and the whole semi-space, the SOXX, it was a textbook outside reversal day.
So it opened strong.
Opened up 1.5% on momentum, looked like it was going to run, and then just completely failed. It closed down almost a full percent right at the dead lows of the day.
So when a market general like that reverses so hard, what does that signal for the health of the index?
It signals extreme vulnerability. If your highest conviction growth names can't hold their gains, it tells you the buying power is exhausted. That's what distribution looks like, and it makes the entire index susceptible to a break.
But that capital had to go somewhere. If it was leaving expensive AI, where is it rotating to?
Some of it was hiding in cheap value. The small caps, the IWM, actually printed a hammer.
Like a completely different pattern.
Totally different. They opened deep in the red, looked like they were capitulating, and then staged a really powerful recovery to close flat.
So money leaking from expensive growth, hiding and beaten down value. It's a purely defensive rotation.
It is. But even the day's leader, energy, showed some skepticism. The XLE broke out to new 52-week highs in the morning, but then it pulled all the way back to close inside Friday's range. It was a failed breakout.
So even the strongest group couldn't hold its gains. The conviction just isn't there anywhere.
Not until we get past CPI, no.
Okay, so that sets the stage for the week. Let's pivot to the look ahead. What's the first test for the market tomorrow morning?
The immediate data point is the NFIB Small Business Optimism Index. It's a huge test for that whole soft landing story. If Main Street is losing confidence, that's a problem.
And volatility traders are definitely not complacent. The VIX refused to break below 1450 all day.
Right, and that's the market telling you it's bracing for impact. Traders are not selling premium cheap because they know OPEX is Friday and then earnings hit. The rubber band is pulled very, very tight.
So let's connect that to the actual S&P 500 levels. Where are the key technical zones traders are watching?
Well, the big ceiling above us is the SPX 6000 gamma wall. It's a massive options gravity well.
Can you explain what it means for dealers to be long gamma there?
Sure. It just means that as the market approaches 6,000, the dealers who sold those options are forced to sell futures to hedge. And as it drops away from 6,000, they have to buy futures. It acts like a giant magnet, just suppressing volatility and pinning the price.
This makes a clean breakout really difficult.
Extremely difficult without a huge catalyst.
Okay, so 6,000 is the ceiling. Where's the floor? What's the danger level if CPI comes in hot?
The key support is 5,920. If we lose that level, the dynamic flips. Dealers are then forced to sell futures aggressively to hedge their positions, which can accelerate the move down to the next support at 5,850.
So the institutional play is to just trade that range until Wednesday.
Exactly. Fade the extremes between 5,920 and 6,000. And given the low volume and bad breadth, the probability of a trend continuation day tomorrow is only about 38%.
So you do not chase breakouts here?
No, absolutely not. You wait for confirmation. Which brings us to a couple of day two plays that traders are watching.
All right, let's look at NVDA first. After that reversal, how would you trade it tomorrow?
NVDA is now an inside day setup. It's coiled. The play is to wait for it to break the range. You'd only get long if it can clear Monday's high, which was $152.40. That would signal the sellers are exhausted.
Okay, and on the flip side, we saw accumulation in Palantir, PLTR.
Yeah, PLTR was a high conviction outlier, closed at the highs on big volume.
So what's the setup there?
That's a high day two continuation play. If it can clear today's high of $74.20 in the first half hour tomorrow, it confirms momentum buyers are in control, and you could see a quick move towards 78.
Okay, so let's synthesize all this. What's the final takeaway for someone listening trying to navigate this market?
The takeaway is that today was a chop shop. Institutions were rotating and de-risking, not accumulating. The guidance from every desk is the same. Stay light, stay liquid. Neutral isn't safe right now. It's just a pause before potential volatility.
And the most important thing for you, the listener, to grasp is that divergence. The S&P 500 price is lying to you. It's being held up by a tiny number of mega cap stocks while the rest of the market is already rolling over.
That is the single most important metric to watch this week. That divergence.
Which leaves us with a final thought to chew on. We saw the small caps, the IWM, put in that hammer candle today and try to recover. But if that broad market index can't catch a real bid and start outperforming by the time we get the CPI print on Wednesday, what does that say about the true health of this market? What happens when capital can no longer hide in those few generational tech leaders? And maybe more importantly, what happens when those last few generals finally give up and follow the soldiers down? That's the structural risk you need to be thinking about heading into the rest of the week.